Hi, I'm Staci from FundCalibre, and today we're going to be looking at developed or emerging markets for your ISA. Where should you invest? Over the past decade, developed market equities with cumulative returns of 213% have significantly outperformed the 83% returns of emerging market equities. However, a closer look at the data reveals that over the last 10 calendar years, the fortunes of developed and emerging market equities have actually been a bit more balanced. Developed markets have outperformed in 6 of the 10 years. Will 2020 see a revival in emerging markets, or will developed markets once again shine? Let's take a look at some economic growth figures first. The IMF, or International Monetary Fund, released their global growth estimates in January, projecting 3.3% growth in 2020 and 3.4% growth in 2021, slightly lower than predicted in 2019 due to some negative surprises and increased social unrest in some countries. I've asked research analyst Ryan Lightfoot-Brown to explain how this breaks down into individual countries.
The IMF expects the US to grow about 2% in 2020, but just 1.7% in 2021. The euro area is projected to grow 1.3% in 2020 and 1.4% the following year. The IMF is particularly concerned about Germany, where manufacturing activity is contracting, and Spain, where domestic demand has fallen. The UK is expected to see growth stabilise at 1.4% this year and 1.5% next year, assuming an orderly exit from the European Union. Japan, though, is the laggard. Growth is expected to be 0.7% this year and just 0.5% next year. In contrast, the outlook for emerging market growth is somewhat higher, averaging 4.4% this year and 4.6% in 2021. Growth in emerging and developing Asia is forecast to inch up slightly to 5.8% in 2020 and 5.9% in 2021. India is expected to grow at 5.8% this year and 6.5% next year, while China's projections are 6% and 5.8% respectively. The envisaged partial rollback of past tariffs and pause in additional tariff hikes as part of a Phase 1 trade deal with the United States is likely to alleviate short-term weakness. However, unresolved disputes on broader US-China economic relations, as well as needed domestic financial regulatory strengthening, are expected to continue to weigh on activity. Growth in emerging and developing Europe is expected to strengthen to around 2.5% both years. The improvement reflects continued robust growth in Central and Eastern Europe, a pickup in activity in Russia, and an ongoing recovery in Turkey as financial conditions turn less restrictive. In Latin America, growth is projected to recover to 1.6% in 2020 and 2.3% in 2021. Mexico is seen as being weaker, and there is social unrest in Chile. Brazil, in contrast, is showing improved sentiment following the passing of pension reform and the fading of supply disruptions in the mining sector. Growth in the Middle East and Central Asian region is expected at 2.8% in 2020, firming up to 3.2% in 2021. The downgrade for 2020 mostly reflects a downward revision to Saudi Arabia's projection on expected weaker oil output growth following the OPEC decision in December to extend supply cuts. Prospects for several economies remain subdued owing to rising geopolitical tensions, social unrest and civil strife. In sub-Saharan Africa, growth is expected to strengthen to 3.5% both years. South Africa, where structural constraints and deteriorating public finances are holding back business confidence and private investment, is weaker, as is Ethiopia, where public sector consolidation and the need to contain debt vulnerabilities expected to weigh on growth.
But does this matter when it comes to our investments? Are the two linked? To a degree, it does matter. It certainly helps if an economy is growing rather than being in a recession, but there's no long-term evidence that the two are directly correlated. How individual companies perform in terms of their earnings and profits is far more important. And if the first few weeks of the year are anything to go by, the two areas are neck and neck in terms of performance. Developed markets are up 4.4%, while emerging markets are up 4.8%. But there are still more than 3/4 of the year to go, and fortunes can change very quickly. Ryan and I take a look at 4 developed and 4 emerging market equity funds you might like to consider this ISA season.
In the developed market, you might consider Marlborough UK Multi-Cap Growth. The UK stock market has been unloved for some time due to ongoing Brexit uncertainties. As and when we get more clarity on long-term trade agreements, that could all change and the UK could return to favour. Marlborough UK Multicap Growth invests in UK companies of all sizes. It will be concentrated in around 40 to 70 names, principally in businesses that are leaders in their sector and can grow regardless of the prevailing economic landscape. Alternatively, you could look at Lazard US Equity Concentrated. The US has had a good couple of years in terms of stock market returns. Of course, another good year isn't guaranteed, but some exposure to the world's largest economy is probably a good idea. The fund is very concentrated, investing in just 20 to 25 companies, ranging from the fairly small all the way through to the very large. It contains the best ideas from across Lazard's US equity funds. Alternatively, a little closer to home is Schroeder European Alpha Income. It offers something a bit different from the standard European equity income portfolio. While many peers will invest in the same dividend aristocrats and have a bias towards quality growth companies, this fund has no such style bias and will invest in more cyclical companies too. At last, and by no means least, there's Japan, an often forgotten developed market amongst UK investors. The Baillie Gifford Japan Trust invests primarily in Japanese small and medium-sized companies, which offer exceptional growth opportunities with sustainable business models.
For those interested in emerging markets, you might consider Magna Emerging Markets Dividend, which invests in well-managed companies with robust business models and, importantly, whose management respects the interests of shareholders. The managers find these companies by conducting on-the-ground research, visiting companies as well as their competitors, suppliers, and customers. Ultimately, they want to invest in businesses that will also pay higher than their average dividends. Or if you want a slightly racier fund, Hermes Global Emerging Markets SMID Equity is an option. It focuses on small and medium-sized companies across global emerging markets. But if you prefer to invest in a certain region, Matthews Pacific Tiger is an option. It's a core Asian equity fund that invests across the region. The team is based in San Francisco deliberately to avoid short-term market noise. They make regular visits to the region and see thousands of companies, including suppliers and customers of potential stock ideas, spending 3 to 12 months researching new ideas. They have a wide range of local knowledge and speak 13 different languages between them. Alternatively, there's Latin America. The labor-intensive and cautious approach of ASI Latin America Equity Fund lends itself particularly well to those volatile, less researched equity markets. The team looks for companies demonstrating outstanding quality characteristics such as strong management, balance sheets, and then targets stocks that appear to be trading for less than they should do. For more information on the funds mentioned, please visit fundcaliber.com.